Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to Galit Altstein. She is a Bloomberg News reporter. She is based in Tel Aviv. Galit, thanks so much for joining us here. What's the feeling in Israel today as these hostages come home?
I think for almost everyone in Israel, this is a very happy day. We've been seeing tens of thousands of Israelis flock since early this morning to Tel Aviv's Hostage Square, which has become a sort of gathering point over the past 2 years for those who have been advocating for the release of the hostages. And it was quite a sight today seeing about, like I said, 60, 70,000 people in the square and in all the surrounding streets with a big stage that kept broadcasting the images of the hostages coming out. People were chanting and clapping their hands and singing and cheering. And it was indeed a very happy day. And I think a sense of relief for a lot of Israelis here.
Galit, there was a moment in that speech when President Trump was talking to Prime Minister Netanyahu directly, and he said he had a lot of guts for knowing when to stop the fighting and for stopping the fighting when he did. Just get us up to speed here on what these last few days have been like. We had President Trump unveiling this peace plan a couple of weeks ago. The devil is in the details. Of course, we were talking about that just a few moments ago, what's going to happen here in Egypt and going forward. But just explain what President Trump was able to do, how he was able to convince Prime Minister Netanyahu to stop that assault on Gaza City that was underway.
Yeah. So we, to be very honest and transparent, I think we only know like part of the answer to that question at this stage. But overall, Netanyahu has generally insisted that Israel cannot stop fighting in Gaza and cannot stop fighting Hamas until it is totally defeated, until it's completely out of power, and until all of its military capabilities are taken out. And what happened here is that Trump, I think, along, with Steve Witkoff and Jared Kushner, they managed to do a few things. On the one hand, they managed to convince Hamas by themselves through mediators that to give up all the hostages at once, at least all the living hostages, because there are still 28 dead hostages that remain in Gaza. And we understand that only about 4 of them are going to be brought back today. So that's one thing they managed to do. But in turn, what Hamas wanted was guarantees that the war will, in fact, end after that happens, and that Israel doesn't just get all the hostages back and then goes back to fighting. And, Trump has basically personally guaranteed that this will happen and that the war will end. And we've heard him say multiple times today on the way to Israel on Air Force One, when he came to the Israeli parliament, that this is the end of war and that the U.S. will make sure that's what happens. So I think these are, the two things that made a difference. The biggest sticking point moving forward will be whether Hamas agrees to disarm. Trump's 20-point plan says that that's what Hamas has to do. Hamas hasn't agreed to do that yet, and that's what Israel insists on. So we'll have to see how that plays out. But the sense is that the war, at least as we've known it in the past 2 years, has in fact come to an end. That's what it looks like today.
Galit, thank you so much for joining us. Really appreciate your reporting from Israel. Galit Altstein, Bloomberg News in our Tel Aviv bureau. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's check in with Lori Calvasina, head of U.S. Equity Strategy for RBC Capital Markets. Lori, it kind of seems to be trade is one of the drivers of kind of market sentiment these days. We got maybe a little bit of a softening of tone from President Trump as it relates to China. And I guess that's what the market likes to see here. What are you making of today's pre-market action?
Well, thanks for having me, Paul. Look, I mean, it's not unexpected to get a bit of a bounce, right, after kind of the big drop that we saw on Friday. I think it's going to be really interesting to see how the S&P 500 trades today. The kids are out of school in New York City. I'm guessing other parts of the country as well. They're thankfully not running around here for me. But it is a quiet day on Wall Street, right? So let's see what we get in terms of the price action. But I think tomorrow is really going to be, kind of the day where I think we start to hear a bit more from folks, in terms of how they're digesting this. And look, I'll tell you, Paul, as I think back over the last 3 weeks, I've been in the UK, I've been running around the US to more cities than I can count and keep track of at this point. And I heard a whole lot of things about people that they were worried about: valuations, AI, CapEx, rate cut. Pricing got pulled forward in the stock market. Labor, inflation, is that going to start to percolate soon? Or are we going to see more of a growth response to tariffs in the market? But the one thing I was not hearing about was that things could, start escalating again with China. So I think what we learned on Friday was that a fair amount of we're on a good path. Things are headed in the right direction. That was really kind of a firm underpinning of this market. So we need to see how that plays out.
It seems like quarter after quarter, Lori, going into earnings season, financials are held up as a bellwether, something that's going to tell us about the health of the market. It's going to give us some insight into the economy as well. So tomorrow we've got JP Morgan, Goldman Sachs, Citigroup on the heels of that. We've got Bank of America and Morgan Stanley on Wednesday. In this odd economy, in this moment, what are those particular companies going to tell us?
So, we'll see what they have to say. Earnings revisions have been pretty resilient there. So my guess is that we're going to have, some pretty good messaging coming out of them, but we'll have to see. The reality, though, your comment about the bellwether, this was something we wrote about in our weekly today. And if I go back the last couple reporting seasons, I could summarize, what we've been hearing from the banks and especially the big banks as, don't worry about the consumer. Everything's fine. The stats all look good. We're really, proud of our consumers for being more choiceful in their purchases. But don't worry, things aren't cracking. And that's not wrong, right? I mean, that's what they're seeing in the data. That's one perspective. But the problem is that you have a lot of people in the financial community that go around saying that as evidence of there's nothing to worry about. And if you actually go and listen to the consumer companies who have the boots on the ground feel, there's some really not troubling, that's not quite the word I want to use, but there are some problems. And so, for example, what we've noticed in the recent consumer companies, kind of those late cycle, off cycle reporters, kind of that came at the last tail end of the reporting season, they were talking not just about the low income consumer being stressed, but the middle income consumer being stressed. There was one company over the last few weeks that said they were seeing stress in the consumer worldwide. We had another company that was talking about how socioeconomic issues are pressuring consumers across cohorts. So I think that we really need to take the financials with a grain of salt. It's an important perspective. It's one that we absolutely want to have and find valuable. But at the same time, they're not able to give us the full picture because only the consumer companies are really able to tell us about the composition of the spend under the surface.
So, Lori, given that earnings are kicking off here, let's put that in context of valuation here. What are the discussions you're having with your clients these days about valuation across the market?
Everyone's worried. Everyone's got sticker shock. And if you just look at our charts on just say the S&P 500 market cap weighted PE, you can do the same thing on the NASDAQ 100, either cap weighted or equal weighted. And we also look at the top 10 names in the S&P 500, and you've basically got forward PE levels that are sitting in line with the recent highs, not necessarily tech bubble highs, not necessarily all-time highs, but highs that in recent years have been difficult for the market to move past. So you're not getting any valuation expansion in this market. And I think that's something, the bottom-up stock pickers I talk to, frankly, are picking up on. And I think they're somewhat alarmed at some of the levels that they're seeing in some of their portfolios. So I do think that earnings are really the big driver here. And we have seen a fade in earnings sentiment. Now, that doesn't mean earnings are going to be a disaster, but the big pop in earnings surprises that we got in the last reporting season, I don't think that we're set up to repeat that.
Paul, you weren't here. I was filling in for you. Lori was on, and I brought up the fact that it seemed like analyst after analyst and strategist after strategist was touting how this was a moment for small caps. And I asked Lori if she agreed with that. And Lori rightly brought out her CV and touted her bona fides when it comes to her experience analyzing small caps in her previous life. And she was skeptical, I think I could say, about the prospects for small caps. And now I'm going to invite her to take a bit of a victory lap here. Lori, what is your sense of where small caps are headed? And what does that tell you about the market more broadly?
Well, look, David, I mean, I always describe small caps as my first professional child. So there's no one more than me who wants them to succeed and wants them to have that moment in the sun and wants them to have that leadership shift. But frankly, I felt a little bit like I was shouting into the abyss over the last few months while the street was just going bananas on talking about small caps and calling for the beginning of this big outperformance cycle. And based on what I'm seeing in the recent trading data, it looks like, it's kind of fizzled out once again. And that's not to say there's not incremental upside in absolute terms, but we're no longer seeing this part of the market outperform the S&P or outperform the NASDAQ 100. It looks like it may have just been another rate cut bet that fizzled out pretty quickly. I think as we kind of head into earnings season, one of the interesting things on small caps that's been coming up recently is whatever challenges they're out there, whether it's, tariffs, for example, back when we had the tight labor market post-COVID, small caps just have a difficult time managing around those challenges relative to their big cap companies. So that's one of the things I'm going to be looking for in this reporting season is to see how small caps are managing through relative to their big cap counterparts.
So, Lori, given that backdrop, what screens well for you guys? I'm not sure if you do it by sector or by factor. Something jumping out at you guys that kind of gets your interest?
So we mostly focus on sectors, and we continue to like the financial sector. Frankly, if we get a pullback in the market, they may not, sort of hold up better on the way down. They are cyclical in nature, but we're not really concerned about that. What we've said is we like them on a 6 to 12 month view. So if there is incremental weakness on a relative basis in the short term, we'd still use that as a buying opportunity. Earnings revisions have been very resilient relative to other sectors. We're basically seeing the rate of upward revisions fade for most sectors in the S&P 500. Ex technology, financials has had a little bit of a fade, but it's kind of paled in comparison to what we've seen elsewhere. Banks, consumer finance, insurance all screen well on our valuation and earnings work. And I didn't upgrade it, but one of the things we have been talking about in recent reports, and we actually said this specifically in the weekly we put out this morning, is that healthcare is starting to look a bit more interesting, especially if you think there's a market pullback that's already started or may be on the horizon. We are neutral, all four of the defensive sectors, but healthcare is one that's been coming up in conversation recently. Valuations look good. Earnings revisions have been a touch more resilient than other sectors, and the flows look pretty good. Policy risk is still a big overhang, but we've had some developments on that, so maybe investors will be able to wrap their heads around that a little bit better than they have in the past.
Lori, very quickly here, I'm curious what your process is as we get into earnings season in earnest, and I know a lot of that involves you kind of going through call transcripts, looking for phrases that stand out. Paul asked about tariffs. He asked about valuations as well. What are you going to learn from those calls, do you think, or what are you hoping to learn from those calls with executives here in the weeks ahead?
So look, we do use tools to, sort of help point us in the right places in earnings call transcripts, but a lot of that's done after the fact. My team, we like to read top to bottom, and we do speed read, but we tend to divide up different sectors. We have some knowledge that we've built up over time of which companies tend to be more insightful than others. And we look at the price action, frankly, to figure out what transcripts we want to focus on. I'm really curious to know more about inventories. So how much pre-tariff inventories are companies still sitting on? Another thing I really want to understand in both the corporate and consumer world is how much demand was or frankly was not pulled forward from the back half of the year into the second quarter as companies and consumers were trying to get ahead of tariffs. I don't think we got good indications about either of those in the last reporting seasons. Companies were a bit vague. Analysts, frankly, I don't think were pushing hard enough to get answers to those questions. And on the issue of pull forward, a lot of companies said they also they couldn't quite tell yet. So I think those are some of my big questions. I'm also curious about 2026. So far, companies are declining to answer when asked about 2026 tariff impacts, but any clues we can get there, I think, are going to be helpful.
Lori, thank you so much for joining us. We always appreciate getting a few minutes of your time. Lori Calvasina, she's head of a U.S. equity strategy for RBC Capital Markets, and we appreciate getting some time from Lori. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's talk about the residential real estate market here. Selma Hepp joins us here. She's the chief economist for Cotality. She joins us here. Selma, the big issue in residential real estate is just affordability or the lack thereof. Is there a solution to this affordability issue? I think about the folks in their late 20s, early 30s looking to buy a house. That's tough out there.
Yeah, it's very tough. Well, first of all, thanks for having me. I'm also happy to be here today. It's really a lot it is right now about mortgage rates, and mortgage rates have retreated from recent highs. They're now averaging between 6.25% and 6.4% for 30-year fixed, and that is the lowest in about a year, which means that affordability is at its best now that it's been in over 2.5 years. So affordability is improving, and honestly, in some markets, you do have relatively quite a bit more affordability than other markets. So in Midwest, for example, and also parts of Northeast, it is clearly more affordable than coastal markets such as New York, Miami, and LA. And so in these markets, you do now continue to see relatively stronger rate of home price appreciation, despite all of these affordability challenges. So markets in Indianapolis, Chicago, for example, even Boise City at this point, again, are seeing relatively more appreciation over the course of this summer than other markets where, for example, in Florida, and markets that have seen cumulatively so much more appreciation since the onset of the pandemic and have, as a result, become so unaffordable, and now home prices in those markets are declining. So it just really depends where you are in the country.
Selma, I want to just ask you another question about consumer behavior here. Paul asking about 20-year-olds and 30-year-olds, and I got to give Lisa Mateo credit for this. She flagged a piece in the Wall Street Journal for us this morning about how young people in particular, faced with these higher than we're accustomed to mortgage rates, have opted not to buy and see as more promising putting money in the stock market where you can get 9-10% return over time, and that's just a better deal for them as they pursue renting. Is that bearing out in sort of what you see in terms of consumer behavior? What are young people doing if they're not buying homes, and what's it going to take for them to once again consider home buying to be so integral to our notion of what the American dream is?
Yeah, I mean, I think the American dream is still alive and well. It's just been a little bit postponed. And with the returns that they're getting in the stock market, it allows them to make larger down payments down the road. So we do see the median age of first-time home buyer be higher than it's been previously. And they're now tend to be about 10 years older when they buy their first home than they used to be. But I think survey after survey shows that, again, American dream is alive and well. And so what they're doing is, and the fact that we can, in many ways, still work remotely or don't have to go to offices 5 days a week, people are moving to areas that are more affordable. They don't have to be in central cities, especially if they have families and, they're looking for good school districts. They tend to move a little bit further outside the cities. They tend to stay with their parents for longer to save for down payments. But again, in our survey, in our data, for example, of mortgage applications, areas that are more affordable in Midwest, for example, the share of first-time home buyer is really high. It's 50 or 60%. So, it just, again, depends where you are in the country and where it's more affordable to buy. People are buying and younger buyers are buying.
And Selma, here again in the New York metro area, we're dealing with a nor'easter here today, which just once again highlights the cost of insurance. If people can even get insurance, whether it's for hurricanes or fire or whatever. Talk to us about insurance costs. I mean, we've been hearing a lot about that as really oppressed on a lot of people.
Yeah, insurance costs have been a big constraint on the market, and in markets that have where costs have gone up a lot or have higher risk of natural disasters, you've seen home sales being impacted. So in those markets, home sales do tend to fall out of contract because people cannot get insurance. Overall, insurance costs have gone up about 40 to 50%. Again, in some markets, significantly more, particularly in Florida and actually parts of Midwest where you don't think about insurance costs being high, but they are because there's persistent tornadoes, for example, or hail. And so not big natural disasters, but more persistent natural disaster. That's where we see large increases in insurance costs. Again, it is a big concern, but you do see some stabilization in the markets. There's been regulatory changes in markets like Florida and California, for example, and that's helped improve accessibility to insurance. But when you think about, costs in insurance continuing to go up, forecast after forecast do show that those costs will continue to go up. really the biggest thing is concentration of residential valuation in areas that have high exposure to natural disasters.
Selma, let me ask you lastly just about what you're seeing when you look at survey data about the U.S. consumer, how he or she's feeling about the economy. Is her prospects going forward? We're at a moment here we're kind of struggling because we don't have the data that we're used to having, the harder data that we're used to having because of the government shutdown. From your surveys, from the so-called softer data, what are you learning about the health and optimism of the U.S. consumer today?
Well, unfortunately, especially unfortunately for the housing market, consumer confidence does remain fragile. There's been a lot of, as you said, economic uncertainty, policy uncertainty. Most recently, what seems to weigh on consumers' mind is job security and income stability versus, for example, fears of tariffs earlier in the year. The other thing we do see is, again, bifurcation, income bifurcation. So upper income households are doing better. And when you look at home sales activity, it's performing better, and price stability is better in upper income or higher priced homes than lower priced homes. So again, it's about income, and there's regional variation. But I would say that consumers continue to be very fragile, and they are very responsive though to mortgage rate changes. So with most recent decline in mortgage rates, we've seen consumers are coming back in home buying market.
Selma, thank you so much for joining us. Always appreciate getting a few minutes of your time. Selma Hepp, Chief Economist for Cotality. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get right to it. David Maxwell, Managing Director of Sustainable Development Capital, co-manages a 650 million euro green energy solutions fund investing in energy transition and infrastructure across the U.S., Canada, UK, and Europe. David, thanks so much for joining us here in studio, braving the nor'easter. We appreciate that. Is this administration supportive of the energy transition from your perspective, or is it kind of a headwind here? What are you guys figuring out so far?
Yeah, it's a good question. I think the important thing to focus on is the problem. So I think we all know that in the United States, there's going to be a surge in electricity demand driven by the AI boom, by electrification, by onshoring. And the question is, what do you do about that? Because we don't necessarily have the generation capacity or the transmission infrastructure to meet that growth in demand. And so I think that the general consensus is that an all of the above approach is required. And in that context, certainly things like distributed generation and energy efficiency are massively important in terms of filling the gap. I think when it comes to things like the Big Beautiful Bill, which was passed on July the 4th, certainly there are going to be some headwinds associated with utility scale, solar and electric vehicles. But at the same time, if you really look at the text and the way that the BBB has been discussed, there have actually been lifelines thrown to, in fact, major parts of the energy transition and technologies associated with it. These include things like some runway for distributed solar to continue to benefit from investment tax credits until the end of 2027. The Big Beautiful Bill supports geothermal. It's quite useful in terms of batteries, hydroelectric power, carbon capture and storage, and other components. So I think that we just have to take a pragmatic view. One of the positives that has come out of discussions, and we recently hosted an event during New York Climate Week, was that actually the fact that this has been passed and that there's policy certainty is a very positive thing for the types of sectors that we invest in. And certainly uncertainty is unhelpful. And so actually we feel pretty good and comfortable and quite bullish on the investment strategy that we deploy within SDCL.
I'm curious how much you and investors can tune out some of the politics surrounding energy right now. So I think of friends who live in Rhode Island or Massachusetts who have seen such great expenditure and investment in wind farms on the ocean. Now we see administration taking a very adversarial approach to that. Obviously, this is being fought out in the courts. But when you look again at that level of investment and put it in the crucible of politics, is it your sense that cooler heads will prevail? Enough has been built. These are close to being finished, that they'll end up being operational, or is it something that actually should be of concern to those who saw the prospect of this kind of broader-based energy future and are now wondering if we're going to have wind energy and other types of energy going forward?
Right. I mean, I think the thing to focus on, I think what will prevail is the concept of economic imperative. So going back to the theme, there's going to be an explosion in energy demand in the United States, and there has to be some way to meet that growth in demand. You know, if you look at the kind of investment strategies that we deploy within SDCL, they focus on downstreams, they focus on energy efficiency, where the energy is consumed, how it's bought. And those sorts of themes are quite, in some ways, immune to the policy because they don't rely on policy incentives. Energy efficiency, distributed generation can really stand on its own 2 feet. And certainly, you know, in discussions with some of the CEOs that we do business with and our portfolio companies, they are feeling that in time to come, and not very long, in sort of 2 or 3 years post 27, that these types of technologies should and can stand on their own 2 feet. Ultimately, I think that's what's going to drive the energy markets going forward. And actually, you can see that there's a confluence of opinions across the pond as well in Europe.
One of the things I'm talking to your colleagues is energy efficiency. How much energy is lost from like where the energy is created, like an oil well, to before it gets into my home? I mean, energy loss and energy efficiency it's a huge issue. How do you guys talk about that?
2/3 of energy.
2/3 of energy is lost
from the point of extraction to the point of use. It's a staggering statistic. It's a staggering statistic. And so that's one of the things that we identified when our company was established. If you can go to a hospital, if you can go to a data center, if you can go to a school and you can save them energy and you can reduce some of that energy wastage by primarily 2 things, by installing on-site generation, which removes all the transmission and distribution losses associated with that large 2/3 energy loss. And if you can go in and do retrofits to make their energy plant and equipment more energy efficient, these things are really good for business. They actually enhance energy security on site. They reduce carbon emissions, they cut costs, which is great for business. And also, it represents a fantastic investment opportunity for us and for the investors we represent.
I know. I never heard that statistic.
2/3.
These guys are on top of it.
I will not forget that either.
Yeah, David Maxwell, Managing Director, Sustainable Development Capital.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.